What is the difference between a floating and fixed exchange ratio? In an M&A transaction where the acquirer's stock is used as part of the purchase consideration, the exchange ratio defines the number of shares exchanged for the target stock. This ratio can either be floating or fixed. A fixed exchange ratio is the fixed ratio of how many shares of the acquired stock are exchanged for each share of the target stock. In a floating exchange ratio, the number of acquired shares exchanged for the target shares fluctuates so as to ensure a fixed value for the target shareholders. This is why the floating exchange ratio is also referred to as the fixed price exchange ratio. Now a follow-up, which one is more common in an M&A? The fixed exchange ratio is preferred to floating because in a floating exchange ratio, the buyer assumes full risk of a price decline. As the bidder, they have initial control of what they are comfortable in bidding, and the acquirer prefers the certainty of a fixed exchange ratio rather than the floating exchange ratio. Now, if the offer price for a company is $10 a share and the acquired stock is worth $20 a share, what is the exchange ratio? Well, the exchange ratio formula itself is the offer price per share for that target divided by the acquired share price. So looking at the offer price of $10 a share and the acquired stock of 20, we divide 10 by 20 to get an exchange ratio of 0.5. So in this respective all stock transaction, the exchange ratio would be 0.5. I recommend that you check out a much fuller video talking about the fixed and floating exchange ratio on my channel, and hopefully if you have any questions, please do comment below.